Perpetual swaps. What does that to do? Is that like stuff that you can make trades on, or you guys are writing about it so other people can understand it?
So perpetual swaps, it's super interesting. It's a version of a future. Traditional futures have an expiration date. So usually every 3 months or so, the future expires and it's settled either with the underlying or it gets settled in cash. And when the crypto exchanges started taking off, that was the product that they offered. And they discovered that retail investors actually had a real trouble managing futures and managing the expirations. People would forget that, third Friday in June or whatever is the expiration date, and they would, log into their account once every 2 weeks, and one day they would log into their account and the position was gone, and they would be like, oh my God, what's happening? So the traditional futures turned out to be not a great fit for crypto. So a number of exchanges started experimenting, and one of them called BitMEX, which was based in Hong Kong in those days, they played with different things. They tried to shorten the futures to have expiration every 48 hours, then every 24 hours. And finally, they decided, what if we never expire this thing? Just make it perpetual. Well, then the issue you have, how do you make sure that the swap price doesn't drift away completely from the underlying? If you don't have expiration that will force those two prices to converge, how do you make sure they don't just, it just doesn't walk off into space somewhere? And the innovation they came up with is they first started thinking of referencing some outside interest rate that would, and you would charge the people who were sort of on the wrong side of the trade. So if the future was too expensive, they would charge people who were long. And the question is, how do you set an interest rate in crypto? Like, what is the Bitcoin interest rate? There's really no good answer for that. So they decided, well, let's just generate it endogenously. Let's just generate it from the price itself. Let's just look at the difference between the price of the swap and the price of the underlying, and let's charge that difference. That will force people who are long to, to be paying a lot of money, and hopefully it will incentivize them to close the position and sell the long position, which will force it back to the equilibrium price. And when they first sort of came up with that, nobody knew if it would work or not. It was a real experiment. It was a kind of stab in the dark. And in the first 6 months, it was pretty hairy. The prices were all over the place. The underlying, the swap price was drifting away from their underlying, and it was a little bit chaotic. But after about 6 months, ARBs figure out how to play this game, how to push it for closer to the fair value. And over the past 2 or 3 years, that market has really matured, and it became the predominant way of trading crypto outside of the US.